This side, Rahul Magan here is a Group Chief Executive Officer, Treasury Consulting. Today, I would be deliberating on a hardcore topic which is titled as Private Credit Space. And before I deliberate on this topic, I have to go in 2018 because the linkage of this topic is vested with 2018. In 2018, from my Singapore office, I shot a video on SoftBank. That how SoftBank investment policies are incorrect, how they are investing in loss-making companies, and eventually this model will bust. I know when I uploaded this video, many people laughed, many people discredit this video, but to me, it hardly matters. I never shot videos for views, counts, likes, and all these things. Because one thing I'm quite aware and satisfied is that my message is being passed to the right person when I upload the video. Today in 2023, what is the outlook of Indian startup story is something which is quite apparent to us. It's like I'm wearing a blue t-shirt. It's a blue t-shirt. I can't say that it's a yellow t-shirt. Or if I'm trying to prove that it's a yellow t-shirt, then I am 100% incorrect. Indian startup story has reached at a level when the job cuts are a normal routine, which means that almost every passing day, when I do the research on the internet and check which Indian startup cuts the job, then almost every passing day I am getting news. Today, there is a news about this startup called Navi, who fired around 200 people. And this is the same startup who is looking for list in India. By the way, there are many startups who looking to list because they know that after listing, they get the substantial money from the retail investors. And listing is a formality, because they are sure that the approval is bound to come. In case of Paytm, Policy Bazaar, Zomato, Nykaa, Cartrade, Delivery, all loss-making companies, but the approval came. Rather, in case of Paytm, the negative retained earnings is to the tune of 16,500 crores. 16,500 crores. Even standing at a negative retained earnings of 16,500 crores, Paytm is being approved at a historic price of 2,150 in India. And they touched the low of, I think, 483, something like that, which ends up billions of losses to the retail investors. But we should be clapping to the compromised business media because they not highlighted this issue. It's not about Paytm, it's about Zomato also. It's about Policy Bazaar also. It's about Nykaa also. It's about Delivery also. Rather, few of them were even approved to split their stock. Because when you split your stock, it looks like that you are on a right track, but you definitely never be on the right track. Because technically speaking, the split never happens when things are going good. No one wanted to float more shares in the market. Every company Rather, every profitable entity in the world, I repeat, every profitable entity in the world is having a clear objective to have limited number of floating shares in the market, because the less the shares, the more value the company would be obtaining. Example, let me go with my favorite company, Ramlal Chole Bhature. So I once again repeat, if really Ramlal Chole Bhature exists, then it's a pure coincidence. So suppose Ramlal Chole Bhature is listed in India, and suppose they have 100 shares. But out of 100 shares, assuming promoters are holding 60%, example, so out of 160 is held by the promoter, but is balance 40. Now, assuming promoter holding 10%, example, and rest is held by the bank, the financial institutions, the private equity, the alternate investment funds, the venture capitalists, the foreign portfolio investors. The total quantum of the float is more as compared to the earlier example. And assuming, if we go with the earlier example, once again, the total float is only 40. And assuming Ram Lal Chole Bhature is a profitable company, and or per Chole Bhature plate, they are making 40 rupees as a net profit. After excluding all cost, salary, food cost, equipment, electricity, facility, everything, they end up making 40 rupees as a profit. And they sell millions of Chole Bhature plate every year in India. It means Ramlal Chole Bhature is a highly profitable entity. And assuming after 1 year of listing, Ramlal Chole Bhature is coming up in public and saying that they are now setting up one more facility in Dubai. Example, they are setting up another entity of Ramlal Chole Bhature in Dubai. Now, it's a profitable entity. And when you set up your business in Dubai, of course, your intent is to be profitable, not a loss making company like Paytm, Policy Bazaar, Zomato, Nykaa, Delivery, Oyo, Swiggy, and the list is endless. In this eventuality, since the float is limited, which is only 40, because 60% is held by the promoters, in this eventuality, the price of Ramlal Chole Bhature would be exorbitantly higher. The reason being, there are less people in the market who hold the stock. And everyone wants this stock because Ramlal Chole Bhature is a profitable company and now they are venturing into Dubai. Since everyone wants this stock, in this eventuality, the price would rise faster, which means supply is constrained. Rather, I should correct myself, it is limited. But the demand is huge, which means the price will go substantially up. While if the Ramlal Chole Bhature, after announcing that they are, setting up another facility in Dubai, and then they do a split, say 1:1. Yeah, you say 3:1, 4:1, 5:1, whatever. The price will not rise, rather the price will fall. Statistically speaking, people call this pro rata, but I tend to differ. It's not pro rata, guys. It is called dilution impact. As we speak, even in 2023, we don't have a right framework before us whereby we can compute the dilution impact. There are hundreds of theories which we have available on the internet, in the books and all, but the right and the consensus theory is not there as far as the dilution impact is concerned. Now, it does raises a very, very big question to me, probably not to you, which is whenever you are buying a stock, the very important thing which we need to look is the fundamental of the stock. We should not look at whether the stock is approved for IPO, or it is not approved for IPO. We should look at the fundamentals. Guys, we need to learn that this funding winter is here to stay. If you're expecting this funding winter is going, and probably tomorrow or maybe in 1 month or 2 months of time, then every startup will start getting the equity funding they used to get. The story like Mojo, the story like Go Mechanic, the story of this so-called Rahul Yadav, Jilingo, and many, it's an end, then you are absolutely incorrect. Remember that majority of the loss-making startups in India are unlisted. Majority. And the day they would be listed, they would be under LODR, which is listing obligation and disclosure requirement, which means clause 41 and clause 49. More importantly, and regulation 30, which is called materiality. We discuss about materiality later. And remember, there's the day they would be listed. In this eventuality, they are bound to disclose the information, which to me, they are not disclosing now. And since they are not disclosing this information, remember one thing, that the investors who are going to be investing in this stock, the only thing they would end up is the losing. Remember that, guys, this funding winter is here to stay. I don't know, you are reading business newspaper in a day, you are doing your research in a day. I don't know, to be honest. But having said that, one thing is clear to me, which is the funding winter is here to stay. And majority of the Indian startups, specifically speaking, loss-making startups, are trying very hard to get IPO approval. Because they knew one thing, that as the time would progress, the chance of having an equity funding would be very less. It would diminish, technically speaking. Henceforth, the right approach is to make sure that you list in the company as a form of a company. And then whatever happened to the share price, you know how India works. Like Paytm listed at 2150. It touched around 500. Did anything happen to this Vijay Shekhar Sharma? Did any officer of Vijay Shekhar Sharma, his board, his CEO, CFO being prosecuted? No, it would never happen. It would never happen. A stock which was listed at 2150 reached to 500. Even after listing, Paytm reported losses. The negative retained earnings grew. But even after that, the investors are completely silent. I request you to open Google and check a very important concept, which is called Paytm LODR policy, and specifically speaking, regulation 30 policy. Or what you can do, you can type Paytm materiality policy. Materiality comes under regulation 30 LODR, listing obligation and disclosure requirement. You please download that and study this. You will get to know something which the media would never tell you. And specifically, if you look at the fresh disclosures which being issued by the Securities and Exchange Board of India covering LODR, which includes regulation 30, you compare this with the earlier policy of materiality of Paytm, you would get to know something. But if you're expecting the media would be highlighting this, it would never happen. And why it would never happen? Because media is very clear on one thing, that if there is no demand, there is no supply. No one is bothered to check the negative retained earnings of Paytm. No one is bothered. But yes, when the company collapses, then everyone will shrug off his responsibility and pass the entire responsibility to the regulator. Because we shrug off our responsibility and we say it is the regulator. But I tend to disregard to an extent, because we can't shrug off our responsibility.
Absolutely.
As the time would progress, the private equity, the venture capitalist funding cycle would contract because of the geopolitical issues also, because of the ecological issues also. You heard me very right. Ecological issues also, which we not deliberated, probably some other day. This is Rahul Magan from Treasury Consulting Group. You knew my personal number, +91 9899 242 978. +91 9899 242 978.